Kick 'em all they're up, kick 'em all they're down, kick 'em all they're up, and kick 'em all around. Getting kicked all around right now. UPS, United Parcel Service. Hello, Geronimo! Downtown to Chinatown. Currently, what's the one day look like? Currently down 8.5%, 179.10, and it is active. That thing is Action Jackson right there. Earnings. Here's a look at their earnings that they reported. Hey, that number is not accurate. So they reported expected earnings per share, $2.21 a share. They reported $2.20. That's 1 penny. Revenue expected 22.98 billion, and they reported 22.92. So we got a hit on the top, or a miss on the top and the bottom, earnings per share and revenue, but it's the guidance that has their stock downtown to Chinatown right now, because they're saying, I don't know, this is the outlook for the rest of the year as far as our volume of shipment, which then of course directly relates to our revenue. We're not liking it. We know me no likey. So is it the classic overreaction? I think it is. So I'm going to trade UPS. Hey, that's a falling knife. Hey, this, believe me, I still have PTSD from the Signature Bank burn job that I got. UPS is a different story because, yes, the stock can continue to fall, but they're not going out of business anytime soon, as far as I can tell. So how crazy of a trade do we want to make? Look at this volatility on the 177.50. Because earnings are already passed, the volatility has gone down a bit, but because the stock is downtown to Chinatown, you still have pretty decent action on only a 3-day trade at 177.50. I mean, it could go down to that number today. What does 10 days out look like? 10 days out on the 175. That one seems interesting, doesn't it? Only 10 days out on the 175. So it's $1.29 divided by 175 divided by the number of days, 10, and then multiplied by the 365, 26.9%. Now that's at the 175 strike price. Let's take a look at the U to the P to the S. Believe it or not, I used to actually have a job. I had a couple of jobs back in the day. In my early 20s, I worked for UPS, and I ended up being promoted to supervision, to a management role, and was the youngest UPS supervisor in Indiana at the time. They made a mistake, didn't they? Probably made a mistake, but I'll tell you the whole story one day. But it was literally at 3 a.m. because I was the preload supervisor. So I supervised the guys that loaded the brown trucks. This was before the super sweet technology that they can take advantage of now. So if we look through the year, I'm going to go back to that story in a second. So as low as 173.84, a lot of stocks were way downtown to Chinatown on January 5th. Other than that, what are we looking at? 176.15, 176.61 as far as lows of the year. Now, again, they just reported 2 misses on the earnings and a gloomy outlook on the rest of the economic year for them, but it's still a stock that we would like to be involved in and hold it long term. So I bet that premium is going up as we speak. $1.24, $1.30 on the 175, $1.31. Should you just let it ride? 178.59 is what it's doing now. Let's go back to it and go to the chart. Let's do the old 1 day, 1 minute action. It's going to bounce around all day, I would imagine. But I believe, and I really believe this, and it doesn't mean any part of it's true, that this is the old classic overreaction. You see, when you look down here at the RSI, it was way downtown to Chinatown here. It was at 1523. Currently, it's at 4. What's it at? What does it say? 39.65. So it's, and the RSI gives us an idea of oversold and overbought. So when this number is higher, when this RSI is higher, like up here around 70 plus, and it's typically indicating that the stock is overbought. And then when it drops down and you see the little red line we got in there, the red shadow above the line, that is indicating that, hey, based on what's happening right now, it looks like it's oversold, which might be an opportunity for you to buy it if you wanted to buy it right now. But it's still going down, bouncing, bounce, baby, bounce. So 178.49, 44. It's a little sell-off happening again, which means that now we're at 139. Look at that. That's some real action going on there. Which, it's a dangerous trade if you were just looking to trade it, but if you had an opportunity to own it at 175, what would the math look like if we used dividend yield theory? Let's go over here to UPS. Look at the dividend scorecard. So they're currently at 3.31% dividend yield forward with an annual payout of $6.48. Okay. So we can figure out the very second of the dividend yield right now by taking the annual payout of $6.48, and then divide it by the share price of 178.43. So that's at this very moment, which puts you at 3.63% on the dividend yield, 6.63%. Now we compare that to its current forward dividend of 3.31. Okay, so 3.63, that's higher than 3.31. And dividend yield theory says that if it's an established company like United Parcel Service, over time it will revert to the mean. The mean would be the average. Okay, so if the dividend yield that we just ran the numbers on, 3.63, is higher than the average, so if we go to dividend yield here, this is going to show us the 4-year average of 2.88. So 3.63, way above that average, which states that United Parcel Service is currently on sale. Now, sometimes that sale is justified, and it's a red flag of things to come. But I say no. I say no. No. I say that it is an overreaction, a potentially temporary overreaction is my hope. So let's look at this as an in and out. It could be that it's a falling knife and we have to cough up the money. But right about now, what if we did a credit spread? What do you think of that? So let's see what we would do here. It'd be $5 wide. If we looked at $5 wide, it'd be a 90-cent credit, right? 90-cent credit. If we did, and we should get more than the 90 cents, right? We should get that number easily above 300 total. 102, 306. Let's see what would happen here. It says low likelihood. Why is that? 99 red Luft balloons. Still saying low. It's saying medium at 98. Review order, put credit spread, $1,500 in collateral, 3 contracts. Okay, so let's run the math on that credit spread. And what we have is $294 divided by the 1,500 in collateral. Okay, that's on paper 19.6% return on our collateral. And then let's annualize it because it's going to get really bananas. Divided by 10 days, multiplied by 365. So that's a 715% annualized return because of the stranger danger. There's a lot of danger involved in this stock that continues to tumble today. So it may even get to a number today that we buy 100 shares of just outright. looking for a little bounce, baby bounce, and then selling covered calls, running the old wheel of fortune. So there is our UPS first trade of the day, only 9:30 a.m. How about that? Here on a Tuesday, April 25th. I'll check back and we'll take an overview look of the market, probably run a couple of put scanners, spreadsheets that we can share and share alike. And I'll see you in the next video.